Hello, my name's Lisa Gardner, and I'm the Associate Director for Research and Content at the Risk and Insurance Education Alliance. Welcome to Alliance Insights. Today's session, Understanding Actuarial Reports and How They Can Drive Cost Savings and Reduce Risk, is led by Marsha Linton and Tim Wander. We're thrilled to have Marsha and Tim with us today. This program is brought to you by the Risk and Insurance Research Academy, where our mission is to advance education, research, and the next generation of talent in the risk and insurance industry. If you'd like to get involved, consider learning more about our work at the high school and university levels. You can also follow us on the socials, share our story, and consider supporting our work through a donation to our Emerging Talent Partners program. Now let's get to why we're here. Marsha Linton is the National Casualty Analytics Practice Leader at USI Insurance Services. She is also a certified risk manager faculty member. Tim Wander has been in the insurance industry since 1985 and worked as a risk manager at Geico Insurance before retiring in 2024. He is a faculty member for Risk and Insurance Education Alliance, teaching and grading CRM courses. Welcome to Alliance Insights, Marsha and Tim.
Thank you, Lisa. Thank you so much. We're so happy to be here. Tim and I also teach the analysis course. As Lisa mentioned, we're instructors. We teach together on analysis. So if you're ever thinking about getting a certified risk manager designation and you like what you see here, then feel free to join us on our journey at the Certified Risk Manager program. So with that being said, let's get started. We're here. What we're trying to do here is help you understand how to look at an actuary report and make the most of it. We're not here to teach you how to be an actuary or crunch the numbers yourself. So while we will go through some actual numbers just so you can see how it works, we're not trying to get you to do it yourself. So keep that in mind when reviewing this. So what are our learning objectives? First of all, we want to distinguish the sections of an actuary report and where your focus will make the biggest impact. And notice that little light bulb on the side. Whenever you see that come up in our presentation, that means that's something for you as a risk manager where you can focus in and maybe have some impact. Remember, the actuary is doing numbers, but they also are using judgment. So you do have some leverage on this to help when things are changing in your program. Imagine if you started a new risk control program, or you did a claims review, or you changed TPAs, whatever that may be. We'll show you how that might help you when you're talking to your actuary partner. And finally, we want to choose ways to manage expectations and mitigate surprises when communicating your results to senior management. Because if you're using an actuary report, you're obviously accruing large deductibles or self-insured retentions. And depending on how large those are, you could have some surprises if a big claim comes that wasn't expected.
Good morning, and thank you, Marsha, for that great overview of the learning objectives and for our agenda that we're going to be using today. First, we're going to talk about the benefits of using an actuary or an actuarial firm in the review of our reserves. Then we'll talk about the uses of an actuarial study. So in using that actuary, they're going to produce an actuarial study. All right, how, as a risk management professional, can we use that actuarial study in our job as risk professionals? Marsha's going to talk about the components of an actuarial report. And then peel back the onion a little bit to see what's in an actuarial report so we can get a better understanding of the information that's in there, which will help us in our using that information. And then we'll kind of end with some general risk management issues that can arise from the use of this actuarial study and some of the risk management pain points sometimes that come up and how we can resolve those issues for us as risk management professionals. So what are the benefits of using an actuary? A couple of things. You see objective third party. So it gives us an objective third party review of our liabilities facing the organization. That can certainly help with Sarbanes-Oxley or SOX compliance. Again, that was driven out of the Sarbanes-Oxley law that was passed back in the early 2000s. Also, objective third party, you might have your internal finance or treasury department may require you as the risk professional to have an outside third party do this actuarial study of your reserves. Oftentimes with auditors, well, auditors may not be willing to sign off on insurance reserves without having some supporting documentation, i.e. an actuarial report, in support of those reserves. Certainly those outside auditors, they're more comfortable with someone outside the firm estimating those unpaid losses. That can certainly help eliminate any biases that someone internally may bring to that effort. It's certainly better than a risk manager doing a back of the cocktail napkin estimate of reserves. We want someone from outside the firm estimating those unpaid losses. It certainly helps not only internally, but helps you as the risk professional. Hey, this isn't something that I came up with on my own. It's an outside firm did that estimate of our unpaid losses. And certainly our broker can help with the estimation, either as a standalone or with updated reports. I've used my broker in the past to help with the estimation of our actuarial reserves. Or you can also use an outside auditing firm, but someone like Marsha's role at her firm certainly can help with putting together this actuarial analysis of our reserves. And so most importantly, you want an outside third-party objective review and estimate of our unpaid losses. So what are some of the other benefits of using an actuary? Well, here's an example. You're a new risk manager and you discover the company is under accrued for workers' compensation and general liability reserves. Now, raising those reserves has a direct impact on the company's financial results. What do you do as the new risk manager? Well, three things. Polish your resume. Or secondly, you can certainly tell your boss. And then third, call an actuary. Get a hold of an actuarial firm to help you with that, because you've under-reserved. Why and by how much? You need that objective third-party evaluation of those reserves. It's going to give you certainly some cover as you put forward that information to the organization. So what are some of the other uses? Gives you quantitative support for those reserve estimates. It can certainly help meet the documentation and validation standards required under the Sarbanes-Oxley law. And it gives you an independent analysis that can reduce risk of earnings management or reserve manipulation. Perhaps we don't want to put up as much reserves as we think we should. An actuarial report is going to give us objective, quantitative information to help to eliminate that risk of earnings management or reserve manipulation, which impacts the liabilities on the financial statements. And certainly it can be useful for compliance, transparency, and credibility, not only for the organization, but for you as a risk professional, that you're able to demonstrate certainly your compliance with the regulatory requirements, you're being transparent in your reserves, and it gives you, the risk professional, credibility that you're able to provide a third-party independent analysis of the reserves needed for the various lines of business. What else can we use this for? Certainly loss projections, absolutely. Set budgets for your organizations, the different divisions, departments within the organization. Part of the outcome of a actuarial study that Marsha will kind of show and talk about is not only what the reserve estimate should be, but also here's what paid estimates should be. So you can actually make a projection on what our paid liabilities or our claim payments will be in the upcoming year, which are very useful for setting budgets. The actuarial study can help set reserves that are a liability on the financial statements, but also help set budgets for the organization. So here's how much we think we're going to be actually paying out the door in terms of dollars and cents in the upcoming year. And that certainly helps with budgets. It's very useful for negotiating risk financing program with insurers, looking at different deductible options, limit options, and then we'll talk about certainly on also for letters of credit that you might have to produce. Give you some benchmarking information. Not only can you benchmark certainly year over year to see how are we doing in risk management and managing the liabilities of the organization from our workers' comp or GL, whatever our liability lines are. So it gives you some year to year performance measurement and also gives some benchmarking. Hey, here's how we are doing against similar organizations in terms of claims and our liabilities facing the organization. Also gives you information on unpaid loss estimates. Again, it'll show us trends in our frequency and severity. And certainly a actuarial analysis will also focus and identify those large losses that may have an adverse impact on severity. It's going to show which lines of business are responsible for the change. So is it coming from my workers' comp program, from auto liability, general liability, environmental impairment liability? What line of business are these liabilities coming from? Then certainly helps identify areas within the line of business that are most helpful and focus for attention on to try and mitigate the liabilities. What else can we do with that actuarial study? Look at letters of credit requirements. So oftentimes I've used this many times with our insurers on an ongoing basis, determine how much of a letter of credit that we need to provide for the insurer on a large deductible program, for example. And certainly it can help look at our loss development factors, what the financial rating is, and can have an impact on financial rating for the organization. And it's a very, very useful tool in negotiating that letter of credit with carriers, especially legacy carriers. They're going to come up with their estimates of what the letter of credit requirements should be. And with an actuarial study, and I've done this myself many times, we have our ammunition, if you will, with that actuarial study to negotiate with the carriers on what the appropriate amount of letter of credit should be. It's very useful for retention and deductible analysis. So I'm going to take save some premium dollars, perhaps taking a larger retention or large deductible. But then it also means I'm going to be taking on some additional losses as well. And so what is a forecast of what those losses are that I might be taking on with that larger deductible? And also it shows some of the variability in losses and those large losses that can come in, unfortunately, and drive results adversely. And so it'll certainly give you some insight onto the variability of losses over time and from policy year to policy year, calendar year to calendar year. And it gives you some great benchmarking information that you're able to use not only within the organization, perhaps one different division to another or a different line of business compared to another and what their losses are, but also between organizations of similar size and market. So sound like a big report. Here it is, buried in paper. Is that actuarial study killing some trees? Is 100 pages, 50 pages, 300 pages? It's a lot of material in there, but Marsha is going to give us some insight as to what's in that actuarial report that makes it so useful. Marsha?
Thank you so much, Tim. And yes, when we kind of first started talking about this, it was more about the paper, and now it's PDF. But even still, if you get a report that's 180 to 200 pages, it can be very intimidating. How do you know where to focus? You don't really need to look at every page. There's key exhibits that we're going to go through that will help you guide you on where to focus your attention and where you might be able to have some impact. Every actuary report is different, but it's also similar. Most of the time, you're going to have them set up in sections and there'll be a summary. Sometimes if you have lines of coverage, you'll have a separate complete report for each line of coverage, but oftentimes you'll have it all in one big report and then they'll group it all together in the summary section. And that's why there's so many pages. Once we dig down into it, we're going to focus in on just one section. So instead of going through all three sections, because pretty much the analysis is very similar no matter what the line of business is. There may be slight differences, but for the most part, it's going to be similar sections. So we're going to go ahead and start with just the workers' comp now, and just assume once you know what the different methods are that we're using and where to focus, you would be able to do the same thing for the other sections. And sometimes even workers' comp is broken out. A lot of times I'll see California separated and all other states. Sometimes New York is separated. It just depends on your company and what's driving your losses. If there's one state that's very big, like California, and it's a lot, the losses are worse, for example, then you might want to segregate those out. But for right now, we're just going to assume just all work comp together, just to keep it simple for this purpose. So you're going to have a lot of different types of analysis done. There may be more than what we're just seeing here, but we're going to show you just kind of the broadest, biggest types of analysis. You might see different kinds of names for them as well, depending on who the actuary is. But and also remember, when you're in your section, oftentimes you're going to start from the back and move to the front, because what we're going to do is build up all those methods, and then they're going to take all those methods and side by side look at them and decide what ultimate loss the actuary is going to select for each year. So keep that in mind as we go through these different methods. So if you start with the actual versus expected, that's kind of, and we'll walk you through more detail, but that's kind of what's going on with the losses compared to what we expected the last time we ran the report. And that way you can kind of guide you to see where we might see some increases or decreases from the last report. Then we're going to get into the loss development factors, loss triangulation. If you have enough data, you're going to see when we show you what it looks like that you can build your own development factors. And that means the report is more like what you do as a business versus a carrier's entire book of business or an industry LDF. And so that we want it to be most accurate to what you're doing. So we'll show you how the actuary does that. And then you're going to see all these different loss development methods. Sometimes they're called chain ladder methods. There may be other names, but you'll see, we'll show you what those look like. And there's also a method called Bornhueter-Ferguson, which you may or may not have ever heard of, but that's a method that allows us for some of the greener years. And when we say green, meaning more current, we might not trust the actual loss data from just those years because they're so new. So we can combine that with the historical data and kind of give a hybrid method. And that gives the actuary another choice to look at. So then once we've gotten done with all of those methods, then the actuary is going to side by side them, like I said before, and they're going to select an ultimate, which may be an exact number from one of these methods. It may be a rounded number. It may be what we selected last time. This is where the actuary is going to use their judgment, and they're not just crunching the numbers. And then we're also going to do a loss projection. This doesn't always happen on an actuary report, but sometimes it does, that where we do a projection for the upcoming year. And by using the historical data, we're going to run a loss projection. And then finally, at the end, they bring it all together. They take the ultimates minus what's been paid, and we'll show you what that looks like to get our accrual, our outstanding liability, and discounted outstanding liability. And we'll get into what that means as we get into those slides. So here we have actuarial data, and we've got a couple slides on this. And the reason this is super important, I spend so much of my time chasing data because somebody wants something done, but then they don't give me everything I need to get it done. So we need our loss data, and we need it in a sortable Excel file. It's super important that the loss data is currently valued and it has all the fields that we need. We broke out some of those on this slide. The main ones are what's been paid, what the case reserves are, which is what the TPA or insurance company is estimating left on the claim. And then the total incurred is when you combine the paid and the case reserves. Sometimes we need to break out indemnity and medical and expenses separately, depending on the client and how your deductibles are working. If it's workers' comp, we absolutely need to know the state. We need a good claim or file number to identify the claim. And if possible, like for example, with auto claims, there could be multiple claimants in an accident. We would like to have a number that combines all of that together, or some way to do it manually. If we have an 01, 02, 03 indicator at the end, then we can strip that data and do it. But if there's a way, sometimes there's a way when you pull data from your TPA that it'll go by separate claim file, or it would go by occurrence or file number. And we prefer it combined for these purposes. And Tim, I think you pick up here.
Well, just one comment here that Marsha mentioned. You see the losses currently valued. You want to make sure they use current valuation dates. Now, I've seen examples before where I get an analysis from a carrier using data valued as of 6 months ago. And so you can certainly ask, I mean, you're asking this up front anyway, and you have conversations with the actuary that you're using currently valued data to start the analysis before you even go there. Make sure it's currently valued information. Otherwise, you'll be doing it over again because you're not going to get a good result.
And then we also need exposures, good exposure information. And a lot of times I might end up only getting a few years, but if we're going to do a loss projection going forward, we need at least 5 historical years of payroll, number of vehicles, mileage, sales, depending on what you're using. Typically, it works the same as what you're using for your premiums for your insurance quotes. It's the same type of exposure. So workers' comp is typically payroll. Auto might be number of vehicles or mileage, depending on the type of business. Sales would be usually used for general liability, et cetera. But it just has to be consistently done year over year. And then don't forget to provide projected exposures for the upcoming year if you want a loss projection. And then any other information that you have, if you've got industry data, excess reinsurance coverage, that's important if we have self-insured retentions. And those self-insured retention loss runs don't include the excess or umbrella amounts. And we're running analysis on what deductible you or self-insured retention you should have. We need to have complete ground up unlimited losses for every occurrence. So sometimes that means we have to combine different sources of data. And so we need to make sure we're not leaving out any relevant information. Tim,
Marsha, one comment there on the exposures. As a risk professional, I mean, and you probably do this already, you want to make sure, hey, if you capture that information for this year, you want to maintain it in an Excel file somewhere. So every year over year, you can just keep adding to what you've already done. So the actuary is going to ask for that historical information. You already have it. And I've had the question come up before, where do I get that exposure information? Well, maybe go to your, if it's payroll, either go to your treasury department, your finance department, HR, to kind of get that estimate for what, get your actual payrolls for the current period. And then also what Marsha mentioned, you want your exposures for the next policy year or next calendar year coming up. Again, go to those same sources, get that exposure information, keep it. That way you have an ongoing file year after year of this information that's going to be needed by the actuaries.
And that's a really good point. And your broker should also be able to help you with that. And one thing that I just remembered is when a lot of times the most current years are estimates, but if you get an audit from your insurance company that has actual payroll, for example, it may come 6 months afterwards or whatever, whenever the audit comes in, we would like to go back and update those audited numbers and replace the estimates. But then you also might, if your audit comes in a lot lower or higher than what we originally thought, how does that impact your estimate for next year? So it's all making sure the data that we're using is accurate as possible. So what does that look like? Here's just an example loss summary where we've grouped the data by policy year. We have a current valuation date. We have the historical deductibles or retentions, which is really important. And actually, now that I'm getting into some numbers, I'm going to add my laser pointer. My mouse is not cooperating. Hang on one sec. There we go. Laser pointer. There we go. So in this example, we're going to keep it simple and the deductible is the same, but there can be cases where your deductible changes year over year. And there may be more complicated deductibles where expenses are pro rata or outside. Whatever the situation is, your actuary needs to understand how the policy works. But in our example, we're just going to assume all the expenses are within the deductible. And you can see we have historical and projected payroll for every year, and number of claims, and excluding RO just means excluding record only. Sometimes we include record only claims in our count, sometimes we don't, but we show it both ways here. And then we show how many are open, and then the limited paid, limited reserves, limited incurred means we've taken any excess losses above the deductible off. Because what we're doing when we run an actuary report, we're using what you as the client are responsible for. We're not estimating what the carrier is paying. We're estimating what you are paying. So we remember, if you recall, we showed you those different methods that are in the report. And the first one, which will probably be in the back of the report, is the actual versus expected analysis, which can give us a lot of insight into what we might be seeing and what might be changing from the last report. You might end up getting reports once a year. You might be getting reports quarterly. It just depends on your situation. But usually this report is this actual versus expected is comparing to whatever the last report that you had done showed. So are claims being paid higher or lower than expected? Are claims being reported? Sometimes actuaries use the word reported. It means the same as incurred. Are the incurred losses higher or lower than expected? And the answer to these questions will impact the ultimate loss selection. So while we see something, we may not react 100% to it, but we need to dig in and say, well, why is there a change? What happened? Is there some explanation to it? And how should that impact our ultimates? So now we're getting into more number exhibits, and don't focus so much on every number because, again, like I said, we're not here to teach you to be an actuary. We're here to teach you how to look at an actuary report. When you find the actual versus expected, it will look something like this. You'll see what the prior selected ultimate was and the prior limited incurred. This is an incurred or reported actual versus expected. Then you're going to see what the currently valued number is. So in this case, valued as of 9/30. And then we run a bunch of math, and all the math will either be in an actuary report. In this case, we have a legend on the top. A lot of times your actuary will have notes at the bottom describing what each column, what the math is involved in each column. So we're looking at what did we expect was going to happen, and that's based on your development factors. And if you're interested, here's the nice formula, but we're not going to get into that level of detail here. But it's basically taking development patterns and calculating what we would have expected to change. So in this example, we expect $119,000 in losses, but we actually got $168,000. Some of them went down, some went up. And the 2023 year really stands out. That actual incurred versus expected is 187,000 higher. So most likely, if we're looking at the 23 year, and once we get to the part of the report where we make a selected ultimate, it's probably going to go up. And this is one of the reasons why, and we would want to dig deeper and going, what claims are driving this? So the next thing we talked about after the actual versus expected is the loss development triangle. And that is where we come up with your own loss development factors. How do your claims develop over time? And this is mostly a mathematical exercise and a data gathering exercise. It's getting data valued at every 12 months and sometimes actuaries even go to 3 or 6 months. I typically prefer it once a year. I don't necessarily think it's necessary to go every 3 or 6 months, but it doesn't mean it's wrong. You may see that, but we want to have every policy year valued every 12 months to show how it's growing over time. And that this is going to be used by looking at the patterns of your actual data, how they develop over time. We can develop a development factor to be used on the currently valued losses to estimate ultimate. And then this can be a very good tool for you to negotiate your loss projections with your insurance carrier. And if your development patterns are better than industry, you're going to want to share your development triangles with your carrier to make sure they have that information too. And this is the basis for most of the calculations in this actuary report. So what does that look like? I'm sorry.
Marsha, yeah, if I can make one comment on the organization of your data. You mentioned before, you can get it from either a TPA. TPA is a third-party claims administrator if you have one handling your claims. But you, as a risk professional, you may give the contact information to your actuarial firm, reach out to that TPA, to reach out to the carrier. They will get the data. So oftentimes what I ended up providing was the exposure data that we mentioned previously. And then the actuarial firm that you engage, they actually go to the depository, the TPA, the carrier, get that information, organizing that data. And when we develop our own loss development factors that Marsha can look at, again, it's not me, the risk professional. I'm not doing that LDF analysis. My actuarial firm is doing that analysis to develop those factors on our data. So good point.
Thank you, Tim. And when we get into kind of what it looks like, you'll see if you're a firm like where Tim used to work that's big and has lots of data, then you're going to have a good RMIS system in place where you can just click a button and a report will spit out the answers, which is great. But a lot of times, if you've had a client that's not as big as where Tim used to work, you might end up finding yourself having to go to different sources of data, and your broker should be able to help you with this. But that can be the hardest part of developing a loss triangle, is going back and getting old loss data with various different sources. So it just depends on the situation. The best and easiest situation is when all the data is in one spot and we're able to pull a report. But we might end up instead pulling loss runs and manually putting together the report. So how does this loss triangle develop and how does it work? We're going to just kind of show you slowly how it's built. So let's look at this. Let's go back in time and pretend we're in 2005. And we get to the end of 2005, which would be December 31st. We pull a loss run. We run the loss run for the 2005 calendar year, and we find that total incurred dollars are $604,974. So we pop in one data point for our triangle. So that's kind of like the first. This is not enough data, obviously. So let's go to the next page and let's fast forward another 12 months. Now we're at the end of 2006. That 2005 year now has a second valuation. So it started out at 604 or 605 almost, and grew to over $1 million in 12 months. So that is an extra data point on our triangle. And our 2006 year is now 12 months old. So we're able to add in one data point for 2006. So this is a very small triangle. This is why we call it a triangle, because it looks like it. We want to have a minimum of 5 to 7 years, really more like 10 or more. And to have a relevant triangle, because it's that law of large numbers you may remember from statistics a million years ago. But with a triangle, we need even more data than what we would need just for a loss forecast. So here's what it kind of would look like if you don't need to focus on the little numbers, but you can see the 2005 year, we had this little corner, and now we just keep adding on. So the more years you have, this is a nice triangle data set because there's a lot of data points. So we will have more credibility in being able to use our clients' data because we have a lot of data. We still are going to use industry data to supplement this because unless you are really, really big, most companies are going to need a little industry data in there, but it's mostly done based on your own information. So our goal next is to fill in what is the next diagonal we call, because every diagonal is a valuation point. So I'm pointing to one right here. That's one loss valuation point. Then next 12 months is another. So the most currently valued data we have would match our loss summary. And that's this last diagonal. So what we're trying to do is, what do we think the next data point will be? We can use development factors to get there. We also use development factors to get to the end, which would be not the next yellow number, but what would it be when everything's done? That's our ultimate goal, is we want to know what ultimate losses are for every single year when everything's paid and closed. And we're going to show you how the numbers are kind of crunched to get those development factors. So I brought in just the 12 to 24 month columns from the prior page. And I kind of got rid of some of the years in between just so this is not as busy, because it's not so much important every year to show what's happening. So I jumped from 07 to 16, but in reality, your actuary is going to have it all on there. So a lot of times when you're looking at an actuary report, the font is very small on this page because you've got a lot of information. And then the first step in coming up with a triangle is what we call an age to age or period to period development factor. So what the actuary is doing is they're taking the column to the right divided by the column to the left. So for example, this 1.6696, all that is 1,010,000 divided by 604 with the whole number. And all that math is being done for the 12 to 24 month growth. This is not an ultimate factor. This is just a 12-month factor. And then the actuary is probably going to add at the bottom some industry averages, some regular averages. They'll do a weighted average. A truncated average is where we take out the lowest and the highest year and average everything else. We might look at a 5-year weighted moving average, and I showed industry. We also show what was selected last time. So notice there's a light bulb here. This is the first place where you have impact. What rate did they select for this 12 to 24 month period, and does it make sense? And that's just use of judgment. We might say 1.4. We ended up, it looks like the selection was the truncated average in this example, which it doesn't mean it's right or wrong. This was the actuary's judgment. They probably thought, well, let's look at what we used last time. We don't want to overreact. We want to show a trend, but we also don't want to overreact because we want smooth changes year over year. And there is a larger growth rate in this 2024 year, which if you remember on that actual versus expected, I think we saw that. So what's going on here? We might want to dig a little deeper, but this might be an outlier. So that's the kind of thought process that goes on. But there is, if you look, once you get your actuary report, you focus on that selected rate, and we'll see one for every growth period, 12 to 24, 24 to 36, et cetera. That selected row is the row you have impact.
Right. And Marsha, on that selected row, as the risk professional, the risk manager, I would encourage you certainly to ask your actuary, challenge your actuary. Okay, why did you select that number? And have them explain it. Just like kind of Marsha just kind of gave you an explanation. Okay, why we went with that 1.4412. You are perfectly legitimate in asking your actuary to explain that number so that you have a good understanding, because you might be challenged on it later on. Now's your time to get that understanding from the actuary.
Thank you, Tim. And then what you're going to see now is I'm going to bring up just the totals. What I'm going to bring up is this part for every 12-month period on the next page. Oh, actually, wait a second. Never mind. I'm going to also, before I do that, I'm going to show you our selected, let me go back one slide, our selected number here. If we were to apply that times the 12-month number, that would give an estimate of what the 24-month number is, just to show you how the triangle works. Our focus, again, is not so much on a 12-month number, but more an ultimate number. But that's just kind of giving you a background on how that one age-to-age factor might work. Once we bring it down to all of the different age to ages, we have 12 to 24, 24 to 36, 36 to 48. All the averages and industry data is down here. We have our prior selected down here. And sometimes we might, I'm going to throw something out here that's not in our notes, but if you don't have a lot of data, like this client has a lot of data. So we don't need to worry about not having enough information to see when the claims are finally done. If you have a smaller triangle, you might have to estimate a tail factor, which is where we say, well, based on where we stopped, what else might we expect? So the actuary might be throwing in a number here that's based on industry data because we don't have enough information. In this example, we do, because if you see 1.0, that means everything's done or there's no more growth. And we can see there's quite a bit of 1.0s. There would have been in between 2007 and 2016, but we're hiding some of that. So our selection is going to be 1. We're not adding a tail, and we you go row by row by row by row by row, and you make a selection for the individuals. And each of these are not ultimate factors. They are age to age factors. How do we get the ultimate factors? We're going to show you that on the next slide. So we're taking all those selections that we came up with, and we're going to accumulate them. So for the 12-month factor, we're literally going to multiply every single one by across, and that will be how we get to 1.802. A lot of times we like to start from right to left because it makes it a little bit easier. So we will start on the right and drop the number down, which would be 1. And then we're going to take the 1 times the 1 to the left of it to get the next one. So these are all still 1s until we get to right here at 120 months. We end up with a 1.001. And it looks like it's the same number, but there's some rounding. We're going to take 1.001 times 1.001, and it still looks like that. And then 1.001 times 1.02, and that's where we get 1.0021. Take that number times the 1 to the left, and you keep cross multiplying all the way to the front. And then in the end, at 12 months, you end up multiplying all of them together. So what does this in the end mean? Based on our triangle growth, we're saying 1.8020 is a 12-month ultimate development factor. A 24-month ultimate development factor is 1.25, and we go across. Why do we need all of these? Because when you pull a loss run, you're getting a currently valued loss run. And you have to figure out how old is each policy. What is the age of that policy? So let's assume the greenest year is 12 months. If it's been a 12-month-old policy, you could apply 1.80 times those losses and get an estimate of what ultimate might be. If your currently valued loss run is somewhere in between 12 and 24 months, then your number is going to be somewhere in between these two numbers. We call that interpolation. Your actuary can provide you an entire list of all your development factors going from the start and go 12, 13, 14, 15, 16. Oftentimes I see them on the actuary report, or if it's not there, you can ask for that for your loss development factor patterns, and you can get that more detailed information if you need it. So now that we have our development factors, we can do the projection methods. And the most common projection method that you might have heard of is the incurred loss development method. That is where we just take an incurred loss, figure out how old it is, what the age is, figure out what development factor to use, and multiply it times that development factor, and you get an estimate of ultimate. You can do the same with paid losses. We can run a triangle just like I showed you before, but all those losses are now paid losses, and you'll have paid development factors. And you're going to take paid times paid development factor and get another estimate of ultimate. There's a case reserve method, which we'll show you. It's a little more complicated, but I'll show you how that one works, which is kind of a mix of the two. And then I mentioned earlier the Bornhueter-Ferguson methods. That's the hybrid method. We'll show you how that one works. So on the incurred and paid loss development methods, those are the most commonly used, as I mentioned. So here we're showing an example of just the incurred method. So we've got the incurred losses listed year over all the different years. And in this case, the policy year was not exactly 12 months old. It was 15 months old. So that's why you see a 1.582 development factor. But if you went to your triangle, that's not going to be shown on the triangle. It's somewhere in between because it's 15 months old. That question comes up sometimes from accounting people that are trying to tick and tie to the report, and they're wondering, where did this number come from? So depending on your organization and what their key controls are, your accounting people might be wanting to know where did this come from? And that's why you would need to get that schedule of all the development factors. So we're just taking our losses limited to our deductible. So in this case, every year was $250,000. So if there were any large losses above $250,000, we would remove that excess amount and take it, multiply it times the development factor. I call it triangle because we're using the client development factor. And then you get one estimate of ultimate. This may not be what's the final number used in the actuary report, but it's one of the methods. We will run all those other methods, and then I'll show you later how we side by side them and make our selections for each year. So I promised I would talk about the BF method, or Bornhueter-Ferguson method. So especially used more in the greener years where we might not rely completely on the data because there's a lot of open claims still. It's new. The development factors are very high. So you might, your ultimate losses, your ultimate estimate based on paid or incurred might not be as reliable in a green year. So we might use what we call the BF method for that. And what that's doing is saying, let's consider the losses from the greenest years or whatever year we're looking at, but we'll also consider how what has happened in the past. And we're going to blend those two together to get us an estimate of ultimate with the BF method. And one example might be, let's say you're commuting to work. If you still are lucky enough to get to drive to work, a lot of us don't have to do that anymore, and we get to work from home. But if you're driving to work, and let's say your commute to work is 1 hour, and 30 minutes into your commute, you stop at your favorite coffee shop, Starbucks, Dunkin' Donuts, whatever it may be, because you can't handle sitting in the car for an hour without your caffeine. So you go in and you buy your coffee at 30 minutes, and then you get to work 30 minutes later. So your normal commute is 60 minutes. That's your expected loss or expected commute. But what happens if it takes you 45 minutes to get to Starbucks? What are you going to do now? How do you estimate what your total commute time would be? If you were using the loss development method, you would assume you're going to have another 45 minutes to get the rest of your commute done. So your total would be 90 minutes instead of 60. But that might be overreacting, because what if there was an accident your first 30 minutes, but everything's good to go the rest of it? And the BF method would be saying, let's combine our actual experience of 45 minutes, but we're going to use 30 minutes for the rest of the commute. You add those two together and you get less time. You get the 30 plus 45. And that's the BF method, if that helps you understand intuitively how this works. We show you the calculations on how it works here. It's 1 over the LDF, 1 minus 1 over the LDF to get the BF factor. And then you take the BF factor times the losses, and then you add the paids. Your actuary report will show you all the details, but you don't need to really focus in on how it's calculated so much, because it's all just plugged in formulas. It's more about understanding why it looks different than some of the other methods. So remember, our actual versus expected, I believe, was high on the 24 year, and our BF method, our incurred method is 401. Our incurred BF method is coming out a little bit higher at 527. So here we go. So now we look at the losses year over year, and we decide, what are we actually going to select? So notice there's a light bulb here, because this is what actually is used for your outstanding liability, not the individual methods. But this is a page to focus on, where you can flip through the pages and find where are the methods side by side listed, and then select it. Because this is something I see often with risk managers having an impact. If the actuary might be too conservative or not conservative enough, they might have some feedback to the actuary, and most actuaries will listen to your feedback. They're not going to just randomly pick the lowest number for you because you don't want to have to put an actual number in there. That's not going to happen. But if you have logical reasons for why you want to change a selection method, and you can support that with actual data and trends, then your actuary partner should be able to listen and consider that. And notice in this example, oftentimes you're going to see, if there's not a lot of open claims, you're going to see the case reserve method used, because that's focused on what's open. And then as you get to the more greener years, you might see different methods used. And this is all based on judgment. And then finally, in the greenest year, we're selecting the incurred BF method instead of the incurred methods. And again, that's something that you can have impact on. Tim, do you want to add any color to this on how you would have worked with this as a risk manager?
Well, absolutely. And Marsha was absolutely right. When you get to that final column I, and here's their selected, you're perfectly legitimate asking your actuary, okay, well, why did you select the column F, the ultimate method, to get that 528 for the selected. You can have an impact. So if you know there are things going on in your claims or a particular loss or changes in how claims are being handled, you want to provide that information and that insight to their actuary, and they may or may not adjust their numbers based on that. That way, both parties kind of go in with and get a good understanding of what's going on with your claims that's driving this result.
Thank you, Tim. And notice this is this selected number. You're going to see this now as you're probably going from right to left in your pages, so from back to front. But these numbers are going to be pulled into your final outstanding liability exhibit. So let's move to that. Notice we have some other numbers listed here, just some summary numbers here, but then you have your ultimate losses that we just pulled from the prior page. And we have other informational columns, but really the most, how do we come up with outstanding liability? We show I plus J, meaning case reserves plus IBNR, incurred but not reported. Incurred but not reported is the extra stuff this actuary report is adding on top of what's in the loss run. But the real formula, whether it's shown or not, is ultimate minus paid. H minus G will also get you to column K. So paid, it is what it is. But ultimate is the one where we went through a lot of pages and a lot of analysis and a lot of development factor calculation, all those different methods, side by siding them, and then going through year by year and making a selection. This is the only column in this whole entire exhibit that the actuary directly impacts. And then the IBNR is just the difference between what's on the loss run and what the actuary selected is ultimate. So, but really it's column H. And we get to a number, but this number here is a full annualized number. And we have to figure out this last policy year is a full 12 months. It ends at 7/1/26, but we're doing this report through 9/30. So we have to prorate those numbers. So Tim, did you want to add a little color on that?
Well, and certainly this is where in your conversation with your actuary, you know whether all of this data hereby, are you using policy year, calendar year, accident year, and even when you're comparing lines of business to make sure that policy year hasn't changed over time. So you want to make sure that you have conversations with your actuary so you have a good understanding of what time periods you're using here. And then certainly even on when I did this analysis, we did it as of, say, November 30. So we didn't wait until December, 12 months of data. We had 11 months. So again, having that discussion with the actuary so you understand how this pro rata of these estimated losses are going to work.
And I'm just adding, I probably should have clicked these things earlier, but let me go ahead and add the different things that we have. I've outlined the green, which is the selected ultimate is less paid to date equals outstanding liability, as I had mentioned. The IBNR, the incurred but not reported, and I mentioned that it's, I may have mentioned, or I can't remember if I mentioned, it's the difference between outstanding liabilities and case reserves, and it also equals ultimate less incurred. So a lot of these columns will interact with each other, but really the only place where the actuary makes an impact is this column H, and then the rest of these are formulas to back into those numbers. We can show a range from low to high. A lot of times actuaries are going to show your expected number, but might give you a low and a high range, because that way you can decide as a firm, where do you want to book your liabilities? One thing I will say though, is if you choose the high or the low, you shouldn't be changing every year based on what suits you, because you don't want the numbers to be high. You have to be consistent, because one thing that you have to also factor in is your audit firm. Your audit firm is going to look at these numbers, and most of the audit firms are going to run their own calculations, and they're going to look at what you've done year over year, and are you being consistent? Because what you put on your books, that impacts your income statement. It impacts balance sheet. It will impact stock price. And you might remember or not, but if people are manipulating numbers on anything on the financials, and this is one big number sometimes for people, this could make your financials look a lot better if you decide to go lower. You could manipulate things in a bad way, and we want it to be accurate. So your audit firms are there to keep you honest. And we mentioned again, the number that actually is booked on your financials will be the prorated number. And what does that mean? The full year of 918,000 ultimate for this July 25 to 26 year is 918. But if you prorate that and cut it off as of 930, that would drop it down to about 229. And then we plug in the rest of the numbers. So now instead of booking 1,256,000, they're going to show 624. And actually that's the discounted number. We have a number that's calculated outstanding liability, but we also are going to show a discounted number. Tim, do you want to talk about why we use discounted numbers?
Well, and actually we have a terrific slide coming up on why use those discounted liabilities, because you're not paying out all those claims today. In those claims that are open on the books, they may take months or years before they're, before they finally paid out and the claim is closed. Since you're paying out a lot over a number of years, you can perhaps reinvest some of that money using the internal rate of return. Discounting gives you credit for the amount of time you're going to be holding that money based on what your payout patterns are going to be. So I've run into this myself. I absolutely, check with your finance, your treasury department, your CFO. If I would talk to my broker, and then I'd go internally to our own finance and our own CFO, talk to them about, do we want to use discounted reserves or do we want to use undiscounted reserves? So let's post our full, non-discounted reserves on our financials, or do you want to discount those reserves? And if so, then that discount rate is coming from your finance or treasury department, not you as the risk professional. But it certainly kind of goes, you want to find out what is the philosophy of the organization, and are they conservative or not? And that kind of help drive a discount decision. But absolutely check with your finance department, finance area to determine, should you use discounted, yes or no? And if so, what discount rate should we use? You as a risk professional, you're not answering that. You don't have to answer that question. You need to get the answer internally. But it's very important to determine whether you're going to discount those reserves or not.
And then also, I had mentioned earlier, your audit firm too, because, long time ago, people might have been using really high discount rates, like their internal rate of return. Let's say they said our internal rate of return is 15%. The higher that discount rate you use, the lower the discounted reserves are going to be. And your audit firms often don't want you to use something like that because it's artificially lowering the number, and they're going to want you to use more of a risk-free rate of return, which typically, if you were saying, well, how do I know what a risk-free rate of return is? You could look at what a treasury bond would be for your payout years. So imagine if your work comp claims pay out over 7 years, you could go and look up, just Google what the 7-year treasury bond yield is and use that as a gauge. And typically audit firms will accept that. So we also mentioned that we went through and showed you how does the actuary report come up with outstanding liabilities, but it also can help you with your loss projection. And your broker might be doing this for you as well. But those same selected ultimates, assuming that you're looking at a loss projection that's the same deductible that you used before, we'll pull directly from the actuary report. If you are using a different deductible, let's say you're looking at increasing your deductible, you would have to adjust and run the numbers for all of these years at a higher deductible. But we'd still take the same development factors, side by side everything, make a selection, and come up with our selected ultimate. And then we have to do a couple of extra steps when we're estimating next year. We have to adjust for inflation because we're taking data from prior years. We have to adjust for inflation because we're using this to estimate 2025. And things cost a lot more today than they did back in 2017. And then we need to factor in the growth of the company. So this is workers' comp. So we're going to use payroll. And these payrolls have also been inflated to $20-$25. And what we end up doing is we want to get to this severity loss rate. This is the most common way it's done, where we just take our adjusted inflated ultimate divided by the exposure, and we get a loss rate. In this case, I think it's in per hundreds. This gives us a nice benchmark year over year. And this is a very good column to use for benchmarking your own performance against yourself. Like, are you getting worse or better than average? And actually 2023 was the high year. I think I mentioned earlier it was 2024. I got my years flip-flopped, but 2023 was a higher than average year. We have to take these rates and come up with what we're going to use to project our 2025 year. And again, kind of like the triangle, we're going to look at all the years. We're also going to look at averages. We might look at a year excluding high low, all years, 5 years, 3 years. And this is where, if we select whatever we're selecting, in this example, we selected a 3-year average because we had to have a reason to be able to do that. And I'm going to just plug in the rest of these things. And Tim's going to jump in just a minute, because this is a place where you have a lot of impact, because your carrier might automatically go with an all year average or something higher. We're going with something lower. Why are we doing that? And if we can support that and multiply that rate times our projected exposure, that might get us a different loss forecast than our carrier might come up with.
Right. And Marsha, that's an excellent example. The carrier might use that higher loss rate of 1.175, which would lead to a higher projection, potentially a higher premium that you're going to be paying on your policy for the upcoming year, as opposed to working with your actuarial firm. Here is their selected loss rate, and then you're able to have conversations with both your actuarial firm and your insurer then on what the appropriate selected loss rate would be, because that's going to drive ultimately what you're going to be paying on premium for that upcoming policy. I also want to talk about claim closure initiatives, other risk management, risk control initiatives you're going to have in place, and what the impact you expect those to be in the upcoming policy year. All of that very helpful, useful information and conversations with the carrier.
And we often say that this is used to tell your story to the carrier, what's going on. And let's say we hired Tim 3 years ago, and that's one of the reasons why we want the 3-year average, because everything's so much better now that he's gotten in there and closed a bunch of claims. There were lots of good risk management initiatives and safety programs, but we do have this big, ugly year in 2023. So we would have to dig into that. If there's an outlier in there that we can prevent going forward, we need to be able to describe and dig deeper into our story to talk to the carrier and get them comfortable with why that's not a normal year and we don't expect it to continue.
All right. So what are some of the risk management issues that come along with this? One, as a risk professional, be able to see either to sell or to explain your claim philosophy. Or if you work with a TPA, a third-party claims administrator, or the insurance carrier, you want to make sure you understand their claim handling philosophy, their claim reserving philosophy, and they understand you as the client, you as the insured, what your philosophy is. Talk about how you approach claims in terms of the claims handling. Talk about, here's the anticipated impact of our safety program. Here's what we've done in the past. Here's what we have in place. Here's the expectation in the future as to what impact that safety program is going to have. And has there been a change in claim handling philosophy, reserving practices? I've seen this before, where all of a sudden there was a change in reserving practices, and that made a significant change in the numbers that the actuary was looking at. And so they raised the question, wait a minute, how come this year looks so bad? Was it we changed our claim handling philosophy, claim reserving philosophy, our practices? We want to be able to understand what those are as the risk professionals. Note there, Know your claims experience intimately, absolutely. Dig into the details, understand what's going on with your claims. What are we doing with our claims? How you manage those claims? Talk with the carrier, talk with the TPA to make sure you have a good understanding, and then be able to explain that to your actuary, that you have that information as they go through their analysis. Then also you might need to have that information and that understanding to explain these numbers internally within the organization. If you get challenged as a risk professional, you want to have a good, solid understanding of what's going on with my claims, how they're being handled, how they're being reserved as you go forward in this business. You also want to keep track of major events that may have impacted your losses. We certainly saw this from COVID-19 for across industries, across the organization. How has something like that impacted? Marsha mentioned you're looking perhaps at 5-10 years worth of data. And so you also may see some strange variations in the data from the COVID-19 years, 2020, 2021, 22, et cetera. How has that impacted your losses? Has there been changes in operations? Go ahead, Marsha.
Tim, let me jump in one quick thing about COVID. It can, in two different ways that we had to deal with this during COVID. So when we were in the middle of COVID, we were all at home. Anybody who was in an industry that was just more clerical in nature, not a first responder, not a hospital or healthcare company, we saw with workers' comp a huge decrease in workers' comp losses if it was that type of company. So what we ended up having to do in negotiating our programs back then is the history did not predict the future in this example. We had to show our carriers, we actually, in a lot of times with our clients, we showed badge counts and how often people clicked into the office and the reduction of that. And we were able to negotiate a lower loss rate than what we were experiencing in the past. That's one example. Another example could be now, today, we're working with a hospital client, and they had a ton of workers' comp claims that were paid for COVID-19 because they were a hospital. So those claims were paid for workers' comp. So they have a blip in 2020 and maybe some in 2021 of really bad loss year because of that. Though we may want to remove all of the COVID loss data from those loss projections, because what we're trying to do, and this is not for the outstanding liability part, but for the forecast, we want to take that historical data and say, how do we look at historical data in the way things are today in our organization? So that might mean removing all that COVID data to get a more accurate estimate. So back to you, Tim.
Absolutely. And then look at changes in operations, any divestitures or acquisitions within your organization, and what has happened with the losses, either from that divested organization or the one that you acquired, and how does that impact your losses over time? You want to look at your reserve process. Managing, but I also say understanding intimately what is that reserving process like. You as a risk professional, the risk manager, can have a lot of input with your TPA, certainly on how those reserves are set and what that reserving philosophy is. You want to be aware of what's going on in the different jurisdictions that your company does business in, different states, and statutory requirements or judicial changes are going to drive or going to impact your reserves. What operational changes may or may not have occurred in the organization, and certainly what's going on with those claims. Understanding those claims intimately is a very important part of the process.
And I'll just add one more thing on the top section, the divestiture acquisitions. That's a very common thing we deal with. If there's a big divestiture, for example, and it was a division that was really bad losses and not normal, not at all like the rest of the organization, then if you're doing a loss projection, you might want to pull those losses out. But if you do, you must also pull out the exposures in coming up with a loss projection. And a lot of times we can't do that because we can't access both. You need to, if you're going to pull on one side, you got to pull it out on the other side, or else you're going to unfairly lower the numbers. But it still can help you in negotiating your program if you got rid of a bad division.
That's all right. So again, communicate with the actuary as they're doing this analysis for you. Understand what data they need. These actuarial services, oftentimes they're not free, so you need to budget accordingly for that. Sometimes that actuarial information can also help drive allocation, how you're going to allocate losses within the organization, between divisions, between departments. Again, the actuarial report gives you some of the support for those allocation strategies. Be sure to communicate when you need that report. Give it to the actuary, get the information to the actuary, say, I need it within X number of days, because your finance or your treasury department may need it for their year-end financial reporting. So make sure you know what date your finance department needs it, because that's going to drive when you need to get this report from the actuary. Again, once you receive the report, then certainly have the discussion with them on any questions you have on the results, kind of what we mentioned before. You can challenge the actuary, have them explain how they did some of their analysis to you, because that'll help arm you with information to help you explain it to your internal departments.
Yeah, and remember, your actuary is your partner. If they're not, you need to find a different actuary. And remember, you as the risk manager know more about what's going on in your company than any vendor, including your actuary. So if you don't tell them what's going on, they're not going to be able to factor in those changes in their analysis. So make sure to keep those lines of communication open.
Right. And then certainly conversing with your management team. Again, the bullet there, managing expectations, surprises, kind of give your senior management or the recipients of this information kind of a heads up. Here's kind of what it looks like. Here's what we kind of expect, to try and mitigate those surprises. How do you do that? By communicate. And then set those realistic deadlines to the actuary. Here's the date I need that report, because I have X date I have to give it to my finance department or treasury department. And then have conversations with your management team on how you're going to allocate costs to the business units, costs of the actuarial report, or certainly the loss costs, and how those might be allocated to the different departments. So again, communicate with the management team, with your actuarial team, with your TPA, with the people handling your claims, so that you understand as a risk professional the entire process going on within the organization with regard to your claims.
And that's all we have for you. We want to thank you if you stuck with us the entire about 60 minutes or so. And hopefully this was very helpful for you in helping you negotiate with your actuary and get the best outcomes.
Thank you.
Thank you, Marsha and Tim. Just a jam-packed presentation full of great stuff. You can see from their clear and informative presentation why we at the Alliance are glad to have them teaching our risk analysis course. If you'd like to learn more about this course or any other risk and insurance education offering, please go to our website at riskeducation.org. That's riskeducation.org. And thanks for listening in.